What are the hidden costs associated with funding that extend beyond the headline interest rate or equity valuation?
Funding's become more complex with different costs associated with it. For instance, invoice discounting facilities often have a very similar headline interest rate, and actually the cost to the business might be determined by the service charge, which can vary quite significantly and is charged as a percentage of turnover. Taking, for instance, debt that is in the mezzanine space, that might come with equity warrants or exit fees, or something called a make-whole, where effectively you have to pay the first X number of years worth of interest. So there are different types of costs that might be associated with your facility that might not become apparent based on the headline rates. Therefore, it's important to get some sort of independent professional advice as to whether or not there are any hidden costs associated with the financing you're being offered.
How can debt covenants in seemingly non-dilutive debt restrict operational decisions more severely than minority shareholder equity?
So when you get to cash flow lending, there will be some sort of covenants that are set in place. The covenants will usually want you to maintain your EBITDA above a certain level, or they will want you to maintain your cash flow within a certain boundary. Some equity providers will give you more flexibility, particularly where you need to invest for growth, where the business might actually take an initial dip before growing very rapidly. Those situations are much harder for debt providers to provide for, and equity providers can then provide for that instead. So it very much depends on the characteristics of the business and its growth plans as to whether or not debt or equity is a suitable result for your business. The key thing to bear in mind is that you need to tailor the solution to what your business needs. If you need any advice, you should reach out to a professional advisor.
Why does the article suggest that cheaper funding typically reflects the risk profile? And what does this mean for businesses with a weaker asset base?
So there are two different types of funders in the market. There are regulated funders that work on PRA models, and there are non-regulated funders that work on some sort of internal rate of return. The internal rate of return models tend to be more expensive, and the regulated funders tend to focus more on three factors: their exposure at default, their loss given default, and their probability of default. One of those there I've talked about is the loss given default. The loss given default is determined by the security that the business has. So if a business has a weak asset base, there's a higher expected loss if that loan were to go into default effectively. What that means is that they then need to price that in. So if there's a higher expected loss, the expected loss needs to be priced into the facility. So businesses with a higher asset base should be getting cheaper finance.
How do different funding structures allocate risk differently? And what should a business consider about its industry's volatility when evaluating this allocation?
Industries might have different appetites with funders, and the macroeconomic situation of the overall economy plus the microeconomic situation of that industry might impact. For instance, the automotive sector has recently been hit by a cyber attack against Jaguar Land Rover. Now we are starting to see funders, both debt and equity, ask more questions around cyber security. That's particularly pronounced in that sector. In other areas, less questions are asked around certain factors based on what's going on in that particular industry. So you need to have an industry by industry understanding of where funders' appetites are in order to be able to best situate that business with a funding provider. If that's something that you need support with, you should reach out to somebody that might be able to give you some advice.